There's so much uncertainty at the moment in the world economy that it will depend on what the new administration actually implements in terms of first executive orders, the policy framework. But I think overall what we can say today is that the economy generally is being shaped by transformational forces rather than cyclical dynamics. We have aging societies, we have technology a big piece, we have geopolitics, of course, the fragmented geopolitical landscape. So all these things on balance will create stickier inflation, more uncertainty, probably more volatility and bigger policy trade-offs given the high debt levels that we have all over the world. So this will be a delicate environment in which to conduct policy, and policy will matter a great deal.
But Philipp, what's the biggest danger over the next 12 months? That the Fed gets something wrong, that the ECB does, that Europe falls behind, or that world leaders are so distracted by what Trump does that they lose their focus on their own economies?
I'd say at the global level, to me, the biggest concern is while inflation has clearly come down, much of it driven by the post-pandemic adjustments, I don't think this inflation story is completely over. So I think, and depending on the policies that will be implemented, I think the biggest risk would be that we wake up and realize inflation is not just sticky, but continues to be stubbornly sticky, in which case, we won't get any of the rate cuts that have been priced in earlier and now have been sort of largely priced out. I think that's the sort of story at the global level. Trade, of course, has a lot to do with this. Protectionism has a lot to do with this. At the European level, I think the biggest risk is just really falling behind on the key issues. I think Europe is losing the digital war. We're losing the energy war. And there is a significant, severe, I would say, competitiveness issue that needs to be addressed in Europe.
But Philipp, why is actually inflation sticky? Is it, and we've seen it in services. How much of it is it that it's just that last mile to get inflation down is very difficult, and how much of it is it the specter of tariffs? And how many Fed cuts do you expect?
Not many, if any, frankly. And the reason for that is because we have these structural mega forces, transformational forces that tend to weigh on the supply side of the economy. And that makes it much harder to get inflation down. So yeah, I believe we've moved from a world that basically had a kind of permanent easing bias during much of the previous decades to a world much more likely that will have almost a permanent tightening bias in policy, given the sticky inflation that will be a feature of these forces that I talked about. Some of it we can address. We could fix the fragmented geopolitics. That's something that policymakers can fix, the new president in particular. It's hard to fix demographics. And so these forces will be in place for quite a while, and I think that leads to, on average, stickier inflation and higher rates for longer.
You worry about Europe. Why do you worry about Europe?
We are falling behind. When I say we, I mean Europe is falling behind dramatically on competitiveness. And Mario Draghi laid it all out in a sense, in a brutal way. It should have been a wake-up call. Not clear what's happening with that. If you just look at the different sectors, you can see we're clearly losing the energy war. We're losing clearly the digital war. And then I think critically, the capital market story in Europe is just not unfolding. Part of the extraordinary dynamic of the U.S. economy, part of the reason why the U.S. is the place to be as an investor, is the depth and this fantastic breadth of the capital markets in the U.S., which Europe is just not able to replicate, even though we pay lip service to it. So I think this is a very significant challenge.
But you also have Germany and France with their own kind of domestic problems. Do you have hopes for the German election? Is Mr. Mersch the right person to actually lead Germany and therefore take a bigger role for Europe as well?
There's no question that the sort of paralysis, in a sense, politically, which we're seeing in many places, the incumbents are having a very difficult time across the world. In Europe, it's particularly problematic at the moment because the classical historic driver, the Franco-German relationship, is not really driving at the moment. And I think it's hard to get this momentum to address what Mario Draghi laid out in his report unless you have strong leadership from the big countries, and that has been absent, which I think is a real problem. And in my view, the new administration should be even more of a wake-up call for Europe to step up on these issues.
Who's the right person to lead Germany in this transition?
Well, we'll see. That's for the German people to decide. But clearly, the policy makeup of the previous administration needs to change. And so change will be a positive. And then we'll see whether that change could be translated into European leadership in order to address these issues, particularly around capital markets, digital, and energy.
Why is Europe so slow on it? I know we're here in Davos. A lot of it will be, of course, some of the participants looking at the inauguration in the U.S. There'll be a lot of talk on geopolitics. But it's AI really the main theme. Do you worry that Europe is over-regulating or that it's falling behind when it comes to innovation?
I think the innovation per se, I continue to be convinced is there. We have great universities, we have great talented young people, we have great innovation, but we don't have the capital markets, and we don't have a deep sort of capital markets union, including banking competitiveness. If you look at the way U.S. banks have dominated since the financial crisis, have increased vastly in size, whereas Europe has not done that. Part of that story is regulation, there's no doubt. And it's going to get worse if the U.S. implements, if the new administration actually implements a kind of deregulation agenda in finance, which has been advertised, at least from what we know so far. That's going to make the gap even greater. So this has to be a wake-up call for the regulators in Europe to decide, do we want to be competitive in finance or not? Do we want to have a competitive, deep capital markets or not?
Right. We've seen, bond yields have been all over the place, frankly, in the last 3 weeks. I mean, it started in the U.S. and it really infected parts of the U.K. market. Do you see this as a possible recurring theme for 2025, including like some kind of credit crunch or something worrying in U.S. markets?
Well, the overall theme here is sticky inflation, higher rates for longer on average, combined, and this is the key, with very high debt levels. And this, of course, is new in a sense, right? This is quite a unique combination, that we have these high debt levels that give you very little room to maneuver, because as soon as rates move up unexpectedly, you immediately run into financing challenges on the deficit side because debt levels are so high. And we saw this at work, of course, classically last week in the UK. I think this will be a feature of this dynamic that I talked about earlier, where you have higher rates on average, volatility in financial markets because of these transformational forces, and you have these very high debt levels as a backdrop that creates a lot of vulnerability.
I mean, what does that mean? That it spells, could it spell disaster if there's fear in the markets? Or again, are there catalysts that you're watching out for?
It doesn't have to spell disaster if governments focus on growth. The way out of this is growth. There's no question. And if you look at what's happening in the UK, what is needed is a clear narrative and a clear strategy around how you create growth. And you can't just do it by public spending. And this gets us back to the capital markets. You need private capital to make the investments that are necessary to generate a strategy that can create growth, that can then get you out of this trap. So I think it doesn't have to spell disaster, but what it probably will mean is that you have important trade-offs on the policy side, uncertainty and volatility in financial markets, but it will also create opportunities. Rates have gone up. We have $10 trillion in money market funds waiting to be deployed. Some of that will move into the fixed income space, infrastructure, private markets, credit. So I think these things, create opportunities as well.